Hey traders, this is Blake Morrow with Trader Summit, and with me today, I'm joined by Lyn Alden. Lyn, I'm a huge fan. It's so nice to have you here.
Thanks for having me. Happy to be here.
All right. So, Lyn, we're coming up on a pretty, annually, this is a pretty big deal for us as traders in the trading community. We have the Jackson Hole Symposium coming up, and there's been a lot of what we see as inflationary pressures building. So, what's your opinion about? We'll start off with inflationary pressures in general, and I think I got a couple of questions regarding that. But I'd also like to get your opinion on what you think the Fed's going to do with tapering and what their timeline looks like, where people should be, where they should be thinking.
Yeah, so the Fed's in a really tough place right now, right? Because on one hand, they still have a lot of economic issues to deal with, but on the other hand, inflation's running probably a lot hotter than they expected. It's certainly hotter than their official forecasts, and so my base case is that they have been preparing the foundation for tapering, right? So they put in some standing repo facilities. They had a number of Fed officials call for tapering a little bit earlier than they previously indicated.
Yeah.
Now, over the past week, they actually kind of walked some of those back to some extent because of the Delta variant. We even have, for example, the Jackson Hole event is now a virtual event, right? So there's
Right.
kind of that narrative cover. And so I think that, if you would have asked me maybe 2 weeks ago, I would have said they're probably going to announce a tapering plan. Whereas now I look at it more like, they could certainly do that, but the probability is lower. And I think that basically they're maybe going to more clearly outline, what things they're looking for to consider tapering rather than necessarily, sticking to a specific tapering plan. Because the challenge they have now is that, if you look at economic growth in rate of change terms, we peaked back in Q2 of 2021. And so if they start to, tighten now, they would be tightening into a slowing economy. Now, it still would be very loose, and so it's possible they'll be able to do that, right? So buying fewer assets per month is still a very loose policy. So they're not actually, they're not doing quantitative tightening. They wouldn't be hiking rates, but they would be, getting less loose than they currently are. And so I think they're kind of still, emphasizing probably that they're data dependent. But I'm as curious as you are to see what their outcome is, at this conference.
It's interesting you bring up the point of Jackson Hole, the symposium going online. It was for us as traders, it was always exciting for, when you'd see all the Fed governors walking around in certain figureheads, whether it was JP or Jamie Dimon or whoever it was, you'd get these sporadic headlines that could really move the market. And for us as traders, that's what we capitalize on. But now it's going to be a little bit different. I don't even know what to expect.
Yeah, no, it's a big challenge, and I wrote about this in my recent report that it really is a big uncertainty point now. And so, one of the ways I've characterized this in terms of the long-term debt cycle, basically they have few options at this point, other than to let inflation run hotter than their interest rates,
Right.
but they don't want to let that get out of hand. And so they're kind of in that really tough spot where they want inflation to be kind of hot, they want real rates to be negative, but they don't want the perception of runaway inflation or that the Fed is not following their mandates. And so they're kind of on that tightrope. And so right now that, with inflation running hot, they do want to taper to some extent, but then they're also dealing with slowing growth. Retail sales are down, Delta wave variant stuff. Some countries are locked down. And of course, the global economy is so interconnected. And so it's a really challenging environment for them.
It really is. It'd be a tough time to be the chair head, I think, right now.
Yeah, definitely.
So let me ask you this in terms of inflation. There's a lot of, it's been a long-term conversation that I've had with several people over the years, but really I wanted your opinion. As far as inflation is measured, is what the Fed uses antiquated to an extent, and should they be factoring in other types of things? What are your thoughts there?
So overall, I consider it to moderately understate, probably quote unquote real inflation. And the reality is that everybody has their own unique inflation basket. And so, the Fed's measure incorporates all sorts of hedonic adjustments. And so, for example, a car has like doubled in price over a certain period of time.
Right.
But if you look at their metric, it's gone up way slower because they take into account the fact that the car is better, right? And so,
Right.
it's that kind of that doesn't really mean a lot to someone who has like a middle class wage, that hasn't gone up as fast as the car and just
Sure.
wants a basic car, right? And so now you can say, even used car prices have soared. The same thing, there's kind of weird issues for housing too. And so, for example, the median home price has gone up a lot faster than CPI. However, with interest rates going down, that's made the monthly mortgage payments not as bad as you'd otherwise expect from just the home value itself. And so, if you were to buy an unlevered home, that's gone up a lot faster than inflation. But when you take into account those lower financing costs, which the feds, because they don't take into account the home price itself, they take into account basically monthly cost of owning a home and renting.
Yeah.
They basically indirectly include those lower financing costs. And so there's kind of like these little tricks that they do. So it's one of those things where, if you're like living in your parents' basement, a lot of your consumption's digital, electronics, things like that. The inflation measure is probably pretty accurate for you. But on the other hand, if you're buying a single family home, if you're raising a family, if you're paying childcare, tuition, healthcare, if you have all these responsibilities, that apples to apples, basket of lifestyle goods over the past 25 years has probably outpaced the official CPI.
That's interesting that you bring all that up. And this brings up the topic of like wealth inequality. I mean, if you're taking the average house price compared to the average US salary, it's ballooned since the great financial crisis, hasn't it?
Yeah, we've had this, we've been in this environment where money supply is going up at a somewhat faster than normal pace. Now, the last 18 months have been unusually fast, but even before then, we've had a pretty fast money supply growth rate. Because of fiscal decisions, because of things that have kept wage pressures down, like automation and outsourcing, things like that.
Yeah.
A lot of that is pushed into asset price inflation, and so the cost of buying an unlevered home, price of stocks, the price of bonds, the price of gold over the past 25 years, right? So gold
Yeah.
used to be like in the lower hundreds. All these types of financial assets have generally gone up faster than say CPI, because CPI measures includes a lot of things that are not particularly scarce, like electronics, software, hedonic adjustments. We should expect over time that our technology makes things cheaper, but we're not really seeing that in capital assets or scarce assets, high quality assets. And so it does, at the current time, kind of, especially this kind of asset price inflation we've had over the past decade, really does impact the say the bottom 90% of the population more so than the top 10% of the population that owns most of those assets.
Right. And so let me ask you this. If you were Fed chair, how would you tackle it?
I mean, that's the tricky thing, is that I don't really see them as having too many options. So, I mean, first
Yeah.
of all, I wouldn't buy corporate bonds and mess up private market signals. I wouldn't want to buy corporate equities like Japan's done, that Yellen has called for back when she was, I think it was like 5 years ago. She
When
wanted
she
the
was
Fed to have
chair.
that.
Yeah.
Yeah, she wanted to have that option. So I wouldn't do that sort of thing. As it relates to their other activities, again, they're kind of in a rock and a hard place. I think that it more comes down to fiscal decisions than monetary decisions. The Fed's kind of forced in a corner where, in order to achieve their mandates, they kind of have to monetize U.S. debt. They kind of have to have negative real yields. So if I was in that position, I would just resign and go back to the private sector. But if I was stuck there, I would do what I had to do for that part, but I wouldn't. I
Yeah.
would try to minimize my interference into the private sector, in terms of affecting corporate rates and things like that.
You're hired. You're hired. All right. So let's turn our attention to the dollar. 2021 has been really interesting. I was making a point on Twitter just over the weekend, or before the weekend was here, that every research report, every bank that you read at the end of 2020 was calling for a weaker dollar, and they were calling for the euro to go much higher. First of all, I'd love to hear your opinion on what your thoughts are on the dollar currently, but how did everybody get it so wrong? And for me, I take everything that I read, especially research, whether I'm reading it from Citi or Goldman, I take it with a grain of salt, but I mean, unanimously, everybody was wrong. So where did they go wrong? What do you think there?
I think a lot of it's momentum. I noticed this too, and it was concerning to me because I shifted from dollar neutral / bullish to dollar bearish starting in late 2019. when we
Okay.
had the repo spike. And I kind of started anticipating right ahead of that, and that repo spike was kind of my catalyst. Then we got it started to weaken from there pretty quickly. Then we got the COVID curveball, so we had a brief spike, and then we had a brief, pretty sharp drop.
Yeah.
And so I had a pretty high conviction dollar bearish case through 2020, and that's what we saw. And so that's part of my longer term dollar bear case as well. I think we're probably in the grand scheme of things heading lower. But by the end of 2020, when I saw that it became so consensus that that there are so many traders on the side of dollar bearishness, I kind of shifted my narrative towards, okay, I'm still a long-term structural dollar bear, but there is such a thing as being oversold and too many people on one side of the boat. And so my narrative became, I don't really know what's going to happen over the next 6 months. I would leave that to technicians, and there's a bunch of variables. It basically no longer became kind of a high conviction near term
Yeah.
thing. So I've been monitoring that for a while now. And so I look for things like higher highs or higher lows. I watch some of the technical levels. And what we've seen over the past couple weeks, for example, is that the dollar strengthened, and we've seen deteriorating conditions in equity markets, especially outside of, say, the top 5 or 10 mega cap stocks. If you look at market breadth and anything that's economically sensitive,
Right.
so I would chalk it up to a couple of things. One is just positioning was way too one-sided going into this year. And two, so far the U.S. has handled some of these economic conditions a little bit more cleanly than the rest of the world. We had say higher access to vaccinations. We had less restrictive, lockdown measures, at least in say the majority of states, compared to some of the things we're seeing out of Australia, parts of Asia. Um, China's had a more kind of they've let their credit cycle play out a little bit more thoroughly than the United States, which was ironic because they have that more kind of authoritarian communist viewpoint, but they've
Sure.
actually chosen the path of capitalism a little bit closer than the United States did over the past 12 months. That doesn't necessarily mean a 10-year difference, but over the past 12 months they've kind of let that credit cycle play out a little bit more. And so there's a lot of capital kind of going into the US for lack of other places to put it. So one of the things I'm kind of watching is to see this Delta variant in rate of change terms, we're probably getting close to the top of the cycle around this time in terms of, say, daily number of cases, and then we head on the downtrend there. We of course see it in different countries first. So Indonesia's already peaked. I'm watching Southeast Asia. The rest of Southeast Asia pretty closely. The United States is a little bit behind that. So every country's kind of on their own time frame. But when you look globally, I think we're kind of moving past this Delta variant. And my overall base case is I would expect to see kind of a, this recent dollar strength and maybe relax a little bit, especially if the Fed ends up, delaying its tapering decision. So
Right.
again, it goes back to what we discussed earlier, where the Fed could try a taper. And if the dollar spikes and the global economy kind of slows down because of that, they might have to delay that or call that off and basically have a failed taper. And so there's actually a bunch of variables there, and I'm more in the framework of based on U.S. trade deficits, based on where the global economy is, based on virus kind of rotations around the world. I lean structurally dollar bearish, but it's kind of a loosely held view for the time being, and I'm kind of just watching technical levels. I'm watching Fed decisions to see how this plays out, and I'm kind of in the dark here, just as anyone else is.
It's interesting if we do see some sort of once again a taper type of tantrum in the market, and then that would argue the case that maybe even the dollar near term would catch some sort of bid. I go back and I've gone back and listened to a couple of your interviews, and we've talked about or you've talked about like the scarcity of dollars, and would that ever come back in your view? Would that ever come back into play where the dollar just catches a bid just on a risk aversion standpoint, as it has in the past?
Absolutely. I mean, I've even joked that, for example, I don't like dollars, but I like to hold some out of a speculation. It's
Yeah.
almost, it's a decent hedge against the rest of a portfolio. And it's one of those, going back to why the dollar is so scarce. The rest of the world outside the United States has about 13 trillion in dollar denominated debt. And what most people don't get is most of that's not owed to the United States. The United States is a net debtor nation. They're not like a big creditor nation. Most of those dollars are ironically owed to China, Europe, Japan,
Yeah.
all these foreign lenders. They lend in dollars even though they're not dollar based. And that's just a function of the fact that, for the past, especially the past 50 years, but even going back further than that, the dollar has been the global funding currency. And so all of that dollar-based debt represents demand for dollars. And so when global trade dries up or there's some sort of slowing issue, you can get a mismatch between supply of dollars and demand of dollars, and that can drive up the dollar. And you kind of have that chicken and the egg scenario where if the dollar gets too strong, the global economy slows down, but also if the global economy slows down, the dollar gets stronger.
Yeah.
And so that's where the Fed jumps in. They do things like swap lines, they do things like QE to try to, arrest the fact that the dollar is spiking. That's what they did back in March and April of 2020. And so my base case is that if we were to get some sort of, kind of vicious cycle of dollar strengthening, the Fed would be forced to step in. Otherwise, they'd have similar issues to what they had in March and April of 2020, where the foreign sector is forced to sell treasuries and other U.S. assets in order to get dollars. Because, going back to that number of $13 trillion in foreign dollar-based debts, they also own something like 42 trillion in U.S. assets. And so if they have to get dollars, they can sell U.S. assets. We have a negative net international investment position. And of course that, not every country's even there, right? So some countries have more debts than assets, like say Turkey, whereas other countries, of course, have more assets than debts, like say Switzerland.
Yeah.
But in general, when you have those dollar shortening periods, they generally have to sell U.S. dollar-denominated assets to get dollars to service their debts and remain kind of liquid.
So when you're talking about like the dollar, and you talk about like some of the broader, the broader bearish picture, if you will, and I tend to agree with you, by the way, as far as the long term. I don't know if I want to call it a dethroning of a reserve currency status, but there's the dollar. Just trading the dollar over the last 20 years myself, I've seen it slowly being used less and less by other nations. But is there a point where the dollar loses its reserve currency status? It's not like there's a flick of a switch or something. What are your thoughts about the dollar losing that status, and how would you view it, or how would it actually look like in your view?
So it's a good question. And I don't view it as a switch. I view it as a dial that basically, it's like it gradually changes over time.
Yeah.
And so by some measures, the dollar peaked back in around 2000, right? So with the introduction of the euro,
Yeah.
if you look at, say, the dollar's percentage of global reserves, it peaked around 20 years ago, and it's been a very, very gradual decline since then. Another way of looking at it is around 2013, 2014 or so. That's kind of another peak we had where foreigners kind of stopped buying U.S. Treasury debt on net for the most part since then, especially China.
Yeah.
And so, either of those two dates could be kind of called the top in the dollar as it relates to its dominance in terms of global reserve percentages. So what we're seeing, now more recently, especially if you go back to say 2017, 2018, we're seeing a little bit more diversification in global reserves and global payments. And so it's kind of been spearheaded by Russia and China. And so China finds themselves in the odd situation where, when this current dollar system was set up in the mid 70s, right? So the United States made deals with OPEC to only sell the oil in dollars. So every country in the world that needs to import oil need dollars. And so that's kind of how this current version of the system began. And back when that started, the United States was the world's biggest commodity importer. So we were the biggest customer of these countries. And we were 35% of global GDP. But now we're down to more like 20% of global GDP, and we're the second biggest commodity importer after China. So
Yeah.
China's like, we're the biggest customer for a lot of these places, but we're using the dollar. And so they have somewhat of an incentive to, they don't want to replace the dollar in the same way because they don't want a lot of the cost of doing so, but they want to be able to buy commodities in their own currency. Or at least in a mix of currencies, because they're the world's biggest trading partner now. They get euros, they get dollars, they get all sorts of currencies. So they want to be able to buy oil and other types of currencies. Then you have Russia, which is one of the world's biggest oil producers, not exactly a friend of the United States. We've sanctioned them a number of times, rightly or wrongly, and so they want to diversify and basically reduce their exposure to sanctions. And so they've shifted towards reducing their treasury exposure, increasing their gold exposure, and increasing their euro exposure. And they've begun selling their oil in euros. And so if you look at trade between Russia and Europe, or Russia and China, it's actually increasingly de-dollarized and shifted more towards the euro. And in Russia and China's case, it's also a little bit shifted towards the local currencies as well, although the euro's kind of been the bulk of it. And so what we're generally seeing over the long run is a diversification of global reserves, which makes sense because the world's becoming more diversified in terms of which countries make up certain percentages of global GDP. So as the United States kind of reverts to a trend where it's a big chunk of global GDP, it's just not quite the 35 or 40% that it used to be. We should expect the dollar to also kind of reduce somewhat importance, especially throughout Eurasia, which is where the bulk of global economic activity is. And so that can take different forms, but I expect a kind of a long-term gradual approach. There could be kind of big events, like if Saudi Arabia announced that they were going to end that almost 50-year history of only pricing oil in dollars. Like there are certain kind of milestones that could happen, but for the most part, I expect it to be gradual.
Yeah. Okay. And that's the way I see it too. It's more of a gradual move away, and we really started seeing that in I want to say it was like 2005, 2006, and I know Russia and China had been really trying to move away from the dollar, but then the GFC happened, and then there was a big rush for dollars, and I think they probably felt they got a little ahead of themselves at that point. But again, it's more of a long-term gradual move away from the dollar. But who could really replace the dollar as a reserve currency, or could it really be China? I mean, what are your thoughts there?
So I think no, because just like the United States is not a big enough percent of global GDP anymore to
Yeah.
maintain like the only reserve currency, there's really not that many forecasts or expectations that China could become big enough either to have that role. And so my base case is towards diversification. People kind of assume that there has to be one global reserve currency, but that's this period, this 50-year period in history is actually kind of unusual. So the fact that most global oil pricing until around 2018 happened in dollars, that's historically unusual.
Yeah.
And so I think we're basically returning to a somewhat more decentralized and normal approach in the sense that there's no single one global reserve currency. There's regional reserve currencies, and so the dollar, the euro, the renminbi, basically there's top 3 or 4 currencies, kind of like the SDR currencies that get used in a pretty meaningful way based on their trading partners and based on the goods and services they want to purchase.
So I did have a question from one of our traders in the Trader Summit community who also asked, is if you're more bearish the dollar overall, would you expect that the dollar really loses value against other currencies, or do you think it's going to be that market share is going to be gained elsewhere, maybe by precious metals or some other asset other than dollars, maybe even cryptos?
So I think a little bit of both. I tend to be, for this decade, looking out this decade, I tend to be dollar bearish, commodity bullish, Bitcoin bullish, pretty gold bullish. Now, as it relates to other currencies, so if you look at balance of payments, so the United States runs a much larger twin deficit as a percentage of its GDP than most of our developed peers, and so historically that would normally balance out. And basically, the dollar would weaken, those other currencies would strengthen a little bit until that imbalance was kind of resolved. Now, because of the structure of the petrodollar system over the past 45, 50 years, that structure has been kind of held open for a while. But it's getting to the point where it's causing all these pain points, not just for the rest of the world, but also for the United States, right? So we've had this bigger domestic narrative of closing the trade deficit, reshoring manufacturing. So far, it hasn't been successful, but it's kind of become part of the political culture across both major parties. And so overall, my base case is the dollar probably will weaken against a basket of foreign currencies. We have to see what happens with the euro in particular, because I often describe that I don't like the euro. I just don't consider it overvalued.
Yeah.
I think it has structural issues. But if you look at their current account surplus, if you look at basically the details of the currency, it's got a lot of issues, but basically being overvalued is not exactly one of them. And so my base case is that the dollar probably will weaken versus a basket of major currencies in the long run. But the way I express that is rather through currency trading, is instead primarily through harder assets that I expect to appreciate across most currencies rather than just the dollar.
Well, that's going to turn me probably to the to another topic, which would be cryptos. But I had another interview with a gentleman named Peter Bookvar, and I'm not sure if you know who he is. And and he's awesome. We interview him quite frequently, actually. And I was having a conversation with him about gold and Bitcoin or other cryptocurrencies, and how It's interesting. We've seen this like divergent movement between gold strengthening, and if gold weakens, Bitcoin or other cryptocurrencies, that basket might strengthen a little bit. And I asked him, is that, do you think that there's, that one is taking away from the other, or, the less gold demand because there's more people looking as an inflation hedge and cryptos or what have you. And his argument was that, there's enough room for both to coexist, which made a lot of sense. But your view on cryptos is probably a pretty bullish one, I'm assuming. But my question to you would be: is it taking away some of the attractiveness that those precious metals once had solely for so many years?
So I've shifted my view on this a little bit, and so it's somewhat in the middle. So back in 2020, my answer was no, I don't think so, because like you described, I think basically the global bond market, the global currency market, that's such a big market compared to how big gold is, compared to how big Bitcoin and cryptos are, where I viewed those as competing against that global paper market rather than just against each other.
Yeah.
And so, for example, when gold peaked in August of 2020 and turned down, I didn't consider that unusual. They were kind of, say some Bitcoiners were saying, "Oh, Bitcoin's demonetizing gold." I was like, no, it's following real rates, right? So it was actually doing what you'd expect it to, based on its very, very long-term inverse correlation with real rates, as measured by, say, the break-even rate, right? So you're looking at kind of the forward expectation of inflation by the Treasury market compared to current Treasury rates.
Yeah.
Now, I started to get a little bit more bullish on gold around March of 2021, and that started to take off, but then it kind of rolled over, and that's the part that's been a little bit surprising. So cryptos got pretty big here in 2021. Their market cap reached over 2 trillion. Gold's market cap is estimated to be maybe 12 trillion, but if you look at the portion of that is for private investment, that's more like 5 trillion, 6 trillion. There's a big kind of range there. And so if you look at the overall size of the crypto market, it's actually gotten pretty meaningful, compared to, say, the private investment gold market. In addition, I see a lot of anecdotal, people saying that if cryptos didn't exist, I'd have to buy gold. And so it's certainly, the introduction of these assets has diversified the types of things that money can go into if they have concern about negative real rates. And so my base case is that I do think it somewhat took the edge off gold. It kind of, splintered the market share of gold to some extent. So before you would have choose between, say, gold, silver, maybe platinum, right? So you didn't have many choices, but now you have gold, silver, platinum. You can go into Bitcoin, you can go into Ethereum. Some of the retail traders go into Dogecoin. Like there's an endless things that they can go into if they have that kind of a inflation narrative. Now I still think that gold probably has a pretty good run ahead of it longer term.
Yeah.
And so I still like a mix of, say, Bitcoin and gold. I would be possibly more concerned about gold if I own 0 Bitcoin, right? So if you're going through this and just kind of assuming that they're going to pick your thing and not pick any of these other things as their primary inflation hedge. So my overall kind of approach is to have like a mix of these different hard assets. So I like monetary assets like gold and Bitcoin. I like silver. I like some of the platinum group metals. I like energy. So I like a bunch of different hard assets, inflation hedges, that sort of thing. And I still have a pretty positive view of gold as well. It's just kind of interesting that I do think that some of the demand has somewhat splintered into a couple of different groups.
It is interesting. I have a couple of teenagers that love to trade around crypto, and they're like, Dad, why do you even have that stuff in your safe? Like, well, I'll just buy a digital asset. Like, and then they look at me and say, "Okay, boomer," or something like that. Anyway, but let's talk a little bit about Bitcoin. And I by no stretch of any means am a Bitcoin. I'm not the right person to deep dive into this with you, but there has been a lot of talk about how Bitcoin mining has really raised energy, or energy consumption of Bitcoin mining is increasing. What are your thoughts on future mining of Bitcoin or other altcoins, or how that works?
So one thing is that most of the altcoins are shifting towards proof of stake, which comes with its own issues, right? So that has it's kind of like how corporations work, right? So corporations are proof of stake, meaning that the more you own of that corporation, the bigger share you get in decision making. So it's
Yeah.
kind of prone towards centralization. Bitcoin is reserving the proof of work, which is kind of the more decentralized, and it links it to the real world, right? So you have to put in real resources in order to get, real value back. It's actually, we've actually, if you look back, for example, almost 100 years ago, Henry Ford talked about a currency that was basically based on energy. And so it's interesting that, about 90 years later,
Here
we
we
had
are.
Bitcoin, essentially currency based on energy. And so overall, if you look at the numbers, Bitcoin mining in terms of its energy consumption, somewhere around 0.1% of global energy consumption, according to Cambridge.
Okay.
And that's the peak level that it reached back during its 60,000 price level earlier this year. Now, and the way that it works in terms of scaling is that because the block subsidy keeps going down every 4 years, the energy increase does not happen nearly as quickly as the market cap increase. It basically becomes more and more energy efficient over time until it reaches some basically its steady state of where Bitcoin miners receive mostly just transaction fees rather than new coins for the production of Bitcoin. And that'd be somewhere, the last coin's not mined until like, a century from now. But really, once you get to around 2030, the vast majority of coins have already been mined. And
Right.
so basically the scaling does not work the way that a lot of journalists think it might when they talk about, its energy consumption. The second point that I would make is that, even despite that very, very small footprint, Bitcoin actually has kind of certain advantages. And so what makes it unique is that unlike most sources of energy, Bitcoin can go to the source of energy, right? So it can go into remote locations. It's not like a data center. It doesn't need large bandwidth and it doesn't need high uptime. So it can go to these remote locations to seek out kind of stranded energy sources. And so what that does is that, when you have kind of stranded, say you have a hydro facility, this happened a lot in China. They overbuilt hydroelectric dams so that all this extra energy, and there was, just no one there in those regions to use it. You can only transmit it so far. And so it'd be otherwise curtailed and wasted. So Bitcoin miners would go in and say, hey, we'll take that energy anyway, since you're going to waste it, and we'll pay you a little bit for it. And so those operators took it. You also see this with stranded natural gas. So when you get oil out of the ground, it often comes with a little bit of gas. And if it's not enough gas, it's not economic to build a pipeline or otherwise, get that and transport it. So they literally just burn it away into the atmosphere.
Hmm.
And Cambridge again has estimated that the amount of gas burned in that way per year of stranded gas is like 8 times the energy to power the whole Bitcoin network globally.
Wow.
And so we've actually seen, I have some friends that, for example, they have companies, they go out, these small companies, they go out and make deals with producers in North Dakota and Texas, and they say, hey, we'll bring like a trailer of Bitcoin miners, we'll hook it up, we'll take your natural gas, we'll buy it off you for a low cost instead of burning it into the atmosphere anyway. We'll monetize it into Bitcoin miners. And so basically what we see overall is that Bitcoin's very flexible nature means that it's mostly taking stranded resources, it's taking stranded energy and using that, in addition to the fact that it's only 0.1% of global energy. So I would think if Bitcoin, for example, goes up another 10x from here, I would expect it to take, say, several tenths of 1% of global energy rather than 1/10 of 1%. But even then, it's still kind of mostly non-rival energy. And so it actually kind of has pretty interesting energy dynamics.
That is really fascinating, actually. So, now I'm gonna cap you off with like one last question about like altcoins, because there's so much speculative nature around all these altcoins, and I'm old enough to remember trading in the dot-com bubble, and I look around and I'm like, half of those or 90% of those companies, they don't exist any longer. And I look at all of these altcoins. There's so many out there. As somebody or as a trader or an investor really that has less experience in the crypto space, what do you say about all those altcoins that are out there? Which ones are going to survive? Which ones are going to stay? What do you actually recommend?
So in the fullness of time, statistically, the vast majority of them should not be very valuable. I mean, there's over 10,000 of them at this
Yeah.
point. And if you look at past cycles of, crypto has generally gone in these 4 year cycles that are roughly correlated to Bitcoin's halving cycle for reasons that, maybe we can't get into now. But, Bitcoin drives the larger market. And every time Bitcoin's in a bull market, even though Bitcoin's scarce, tons of people come in and make their own cryptocurrencies, and they kind of just keep making them until they exhaust demand. And then we go through a bear market, and most of these coins never really had any use case, never had any value. Their network effects are weak. The analogy I like to use is, if I were to, people often say you can just copy Bitcoin. But Bitcoin has a very large network effect. So it has, the most energy kind of backing it up if you were to try to do a 51% attack against it, right? So that makes it more secure. And so if I were to say, want to copy Wikipedia, I can actually copy Wikipedia. I can download all the data. I can host it on my website. But then the question is, would I get that traffic? Would I basically be able to mimic the real Wikipedia? And the answer is no, because even though I can copy the open source aspect of it, I can't copy the millions and millions of links around the internet pointing to it.
Yeah.
And I can't copy the team of volunteers that constantly edit and update the real Wikipedia. I can't really convince them to come and edit mine instead. So I can't actually copy the network effects that makes the Wikipedia the real one. And so with Bitcoin, all these other kind of tokens come in and they make these like shadow Wikipedias, these shadow Bitcoins. They change some of the variables, and they often do very well for a couple of years. But then, 5 years later, they never really went anywhere because just like my failed Wikipedia, they failed to kind of achieve that network effect. So far, really the only coins that have had a really long-term durable aspect to them are Bitcoin and to some extent Ethereum. And even that's not a short, right? So you could have other smart contract platforms, take market share. So overall, I would be very, very cautious about holding, tokens outside of Bitcoin for long stretches of time. Obviously with their volatility and upside, people that are closely following charts can potentially make a lot of gains from trading them.
Yeah.
But basically there's not really room for 10,000, different types of coins. A lot, the vast majority are outright kind of, scam fraud type of things. Then you have, several dozen legitimate projects. But just like many startups and many kind of, network effect things without a network effect, they're kind of destined towards eventual stagnation, much like the dot-com era. So I would just be very, very cautious with tokens, outside of the big one or two.
Do you think, looking back in time and looking back at that peak tech bubble that we have, do you see anything like that ever affecting the whole crypto space like it did the NASDAQ in 2000, 2001? Or do you think that, that might happen to a lot of this space, but Bitcoin will survive, obviously, and continue to outperform?
Well, so far, the funny thing is we've had that happen roughly every 4 years. And so
Yeah.
there's been, really big bear market from 2018 to 2019. But, 4 years before that, there was another giant bear market. And then, maybe 2 years before that, there's another giant bear market. So there's kind of been these three, Bitcoin is dead moments. And those were literally as big or bigger drawdowns than the NASDAQ in the dot-com bubble. I mean, those were like 90% drawdowns for Bitcoin, which is bigger than the NASDAQ drawdown. And so, so far, Bitcoin has been like the Amazon of the dot-com bubble,
Sure.
where, it blew up and then it crashed a lot and then it came back even bigger. And it's done that multiple times. And so it's really kind of the one that's been through a number of those cycles. So far, Ethereum has been through one of those cycles successfully. And most coins haven't really been through those cycles. The big popular ones from the last cycle are almost nowhere to be found in this cycle. And so all the kind of the tertiary coins this time, so like number 3 through number 10, for example, are ones that were either not around in the last cycle or were just not very popular last cycle. And so most of them under the surface keep changing. When they have these big drawdowns, a lot of them don't come back. A lot of them end up being the pets.com rather than the Amazon. And so people just have to be very careful not to pick the pets.com.
That is a great point. It seems like those cycles are happening faster now than they did back in the tech bubble back in the early 2000s. So, Lyn, I just want to say thank you so much for joining us here at Trader Summit. You're a pleasure to talk to. I hope to have you back again sometime in the very near future. But before I leave, I want to ask, how do we follow you and how do we get more information about you, your newsletter? Where do we go?
So I'm at lynalden.com, and I have a free newsletter there, free articles, also a low-cost research service, and I'm at Twitter at Lyn Alden Contact, so people can find me.
All right, Lyn. Well, thank you so much for being with us today, and I will. I'll have you on hopefully sometime very soon.
Yep, sounds good. Thank you.